Welcome to the Deep Dive. Today, we're plunging into a company that impacts billions of lives every single day, often without us even realizing it. Nestle S.A.
That's right.
You might think you know Nestle from, say, their chocolate bars or coffee, but what does it truly take to run a business that's, well, over 150 years old?
And huge, spanning 185 countries.
Exactly. Generated CHF 91.4 billion in sales last year alone. So our mission today is really to unpack the business quality and that competitive fortress of Nestle.
Understand its strengths, its vulnerabilities, too.
Yeah, and explore what it all means for its long-term future.
And we're going, far beyond the headlines here. We're digging into an investment analysis that really breaks down the nuts and bolts.
How they make money, how they stay dominant.
Right, and how they navigate some pretty significant, long-standing challenges. You should get ready for some surprising facts, I think, and a really comprehensive view of this global giant.
Okay, so let's begin by looking at the core of this enduring business. Nestle manufactures and sells a huge portfolio of branded food, beverage, nutritional products.
Pretty straightforward stuff on the surface.
Right. They aren't inventing, revolutionary new categories. But it's the how. Their scale and their consistent execution seem almost unparalleled.
What's truly fascinating here, I think, is the almost deceptively simple and resilient nature of their model. For over 150 years, they've consistently catered to fundamental needs.
Non-discretionary thing.
Exactly. Human and pet needs. Sustenance, convenience, affordable treats, health. And we're talking about, get this, over 1 billion servings of their products consumed daily.
Wow. 1 billion servings. Daily.
It's a truly staggering figure.
And the diversification is incredible, too. That CHF 91.4 billion, that's Swiss francs, for our listeners in 2024, sales was spread across 7 key categories.
Powdered and liquid beverages and pet care lead the way, yeah.
But importantly, no single segment totally dominates.
Yeah.
And geographically, they're balanced, too.
Yeah.
35% North America, 24% Europe.
21% Asia and Africa, 14% Latin America, 6% Greater China. It's really spread out.
So that diversification, it's not just a statistic, is it? It's fundamental.
Absolutely. It's a fundamental insulator against, regional economic downturns or shifts in certain product categories. But the real secret to their endurance, I'd argue, it isn't just selling food. It's owning mental real estate in consumers' minds. Brands like Nescafe or Purina.
They become defaults.
Exactly. Cognitive shortcuts for daily purchases built on decades of consistent product delivery and just massive sustained advertising.
Right.
This psychological lock-in, that habit formation, it's a far more durable competitive advantage than, say, some fleeting technological edge.
Okay, so that psychological lock-in sounds like a key ingredient. What else gives Nestle this enduring power? The analysis points to what's often called an economic moat.
Yeah, those deep, sustainable competitive advantages that protect profits from rivals.
And it's built on 2 interlocking factors here.
Precisely. The first is intangible assets. Primarily their, unparalleled brand portfolio.
Okay.
We're talking over 2,000 brands. And get this, more than 30 of them are billionaire brands.
Billionaire brands, meaning?
Each generating over CHF 1 billion in annual retail sales. Think Nescafe, KitKat, Maggi, Purina, names everyone knows.
Right. Instantly recognizable.
And this massive collection of trusted brands, it translates directly into pricing power and really sticky customer loyalty.
So how does that brand power show up in the market? Does the analysis quantify their dominance?
Oh, absolutely. You see it clearly in their market shares. Nestle holds an impressive 22.1% in global coffee.
Wow.
25.6% in pet care, 15.4% in chocolate. These aren't just numbers. They reflect deep penetration, deep consumer preference worldwide.
Makes it incredibly hard for anyone else to challenge them, I imagine.
Exactly. Really tough for new entrants or smaller competitors.
And beyond brands, the report mentions cost advantages from their huge global scale. How does operating, 354 factories in 79 countries help?
Selling in 185 nations, it's all about volume and efficiency.
Okay.
Their scale means they buy raw materials at volumes and prices smaller players just can't touch. Their manufacturing is optimized for lower per unit costs.
And their logistics.
Global logistics networks providing incredibly efficient distribution. It just allows them to deliver products cheaper, which they can reinvest or use for pricing.
And speaking of those intangible assets, the report has this really striking example. Cerillac, an infant nutrition brand.
Ah, yes, Cerillac.
In some markets, it holds a staggering 97.5% market share. That's practically a monopoly.
It really is.
What does it tell us about parental trust as an intangible asset?
That Cerillac example is like a masterclass in building a moat. Parental trust, especially for infant nutrition, is incredibly powerful, very sticky.
Hard to switch brands once you trust one.
Extremely hard. It makes demand highly inelastic. Parents are just incredibly reluctant to switch, even if prices nudge up. It shows how deep trust can become an almost unassailable barrier.
The report also mentioned something called the Virtuous Circle in Nestle's operations. How does their reinvestment and portfolio management fit into this?
Right, the virtuous circle. It's absolutely key to their ongoing success. Their huge scale generates substantial cash flow. Lots of it.
Okay.
A big chunk of this cash, around CHF 1.7 billion a year, goes back into R&D. Innovation, adapting the portfolio, think plant-based foods, personalized nutrition.
And they're actively managing the portfolio too.
Yeah, divesting slower stuff like those North American water brands and acquiring in higher growth areas like health science.
The circle is.
Scale generates cash, cash fuels R&D and marketing, which strengthens brands, leading to more pricing power and market share, which generates even more cash.
It's a powerful, self-reinforcing flywheel.
Exactly that.
Okay, so we've explored these immense structural strengths, the things that make Nestle such a financial powerhouse. But it's crucial to understand how this giant is actually seen, on the ground.
Yeah, how customers and employees actually experience the brand.
What does that picture look like?
Well, it's definitely complex. No simple answer. For many iconic consumer brands like KitKat, the sentiment is just overwhelmingly positive.
People love their KitKat.
They do. Reviews use emotional, nostalgic language, favorite candy bar, timeless classic. Nescafe is similar, reliable, convenient, cost-effective. New things like iced roast seem well received.
A deep personal connection to the products themselves.
Right. But then you have Purina, and the analysis notes this stark dichotomy.
How so?
You've got a large base of loyal customers, pets thriving on the food, but also a really concerning pattern of highly negative reviews.
Citing what kinds of issues?
Quality control failures, things like bugs or webbing found in sealed bags, even alleged links to serious pet health issues. Plus, some owners criticize ingredients like corn, meat, byproducts.
This sounds like a huge reputational risk, especially in pet care, where emotions run so high.
It is, and it highlights the central tension. Employee feedback also shows a split. Official company messages talk about respect, development, but anonymous platforms like Glassdoor maybe reveal talk of a cutthroat middle management, overwhelming bureaucracy, and even this widespread public perception in some circles that the company is, well, evil. There's literally a fuck Nestle subreddit.
Wow. So it's like this corporate Jekyll and Hyde situation.
Yeah.
You have intense love for individual brands, KitKat, Nescafe.
Right.
But that clashes directly with these really deep, troubling corporate controversies. Child labor allegations, water rights, plastic pollution. How does leadership even navigate that?
It's a monumental challenge, no doubt. For decades, Nestle has been very skillful at insulating its product brands from the corporate controversies.
People buy KitKat, not Nestle chocolate.
Exactly. But the long-term risk is that in our increasingly transparent, socially conscious world, those firewalls could, crumble.
What happens then?
If buying a beloved product becomes directly linked in consumers' minds with supporting a company they see as controversial, the intangible value of the brand itself could be directly hit.
That's the core of their moat, those brands.
Precisely. It's considered a low probability risk, perhaps, but the potential impact is massive, high impact.
Given all these complexities, let's turn to the leadership. The people steering the ship. What does the report say about them and how they handle capital?
Well, Ulf-Mark Schneider became CEO in 2017, and interestingly, he was the first external hire for the top job in almost a century.
That must have signaled a shift.
A very deliberate strategic shift, yes.
Yeah.
His philosophy focuses on nutrition, health, and wellness, and that Nestle virtuous circle we talked about.
So focused on long-term value.
Explicitly. Long-term intrinsic value compounding, not just short-term gains.
And his capital allocation seems to back that up. All that reinvestment, the R&D budget, boosting marketing.
Yes, and it's funded by new cost savings initiatives. Their M&A strategy is also quite disciplined.
How so?
They're not just buying growth for growth's sake. They're divesting non-core things like those water brands or European frozen pizza.
And acquiring where it fits the strategy.
Right. Higher growth areas like the Bountiful Company, that's vitamins and supplements. It looks like rational portfolio optimization, all aligned with that long-term health and wellness focus.
And for shareholders, well, they seem pretty consistent there too.
Incredibly consistent. Increased their dividend for 29 straight years. In 2023, they returned CHF $12.8 billion to shareholders through dividends and buybacks.
That level of consistent return is really something, speaks volumes.
It speaks to the reliable cash generation of the underlying business. Which brings us to the financial fortress. Nestle is just a remarkably consistent earnings machine.
Into the numbers.
Over the past 5 years, 2020 to 2024, annual revenues were always between roughly CHF 84 billion and 94 billion. Net profit reliably in the double-digit billions. Very steady.
Okay, let's talk key ratios. The report mentions return on invested capital, ROIC, around 10.1% on average over 5 years, and free cash flow conversion.
Strong. Very strong. 98.3% in 2024.
What do these numbers really tell us about how they operate?
That 10.1% ROIC for a company this huge and diverse isn't just efficient. It's like a testament to an almost unparalleled ability to generate profit from capital consistently everywhere.
Operational mastery.
Deeply entrenched operational mastery. Few can match it. And that near 100% free cash flow conversion means their reported profits are turning almost dollar for dollar into real spendable cash.
Which is a sign of high-quality earnings.
Exactly. Plus, their leverage, net debt to EBITDA, is manageable, around 2.7x on average. Gives them plenty of financial flexibility.
So how did this financial fortress hold up under real stress? That period of high inflation, supply chain chaos from 2021 to 2023. That was a real test, wasn't it?
It was a generational test, absolutely. And Nestle passed with, well, flying colors.
Yeah.
They used their pricing power, implemented significant price increases to offset those soaring costs, and critically, they did it without completely destroying demand.
A sign of that brand strength again.
Definitely. Free cash flow took a hit initially, but then rebounded powerfully. Over CHF 10 billion in both 2023 and 2024. The business bent under pressure, sure, but it absolutely did not break.
So after digging through all this detail, the strengths, the controversies, the financials, what about the stock price right now? Is it a good time to buy this kind of quality?
Well, as of late June 2025, the valuation metrics, price to earnings PE ratio is roughly 19x to 21x.
Okay.
And price to free cash flow, PFCF, is around 21x to 22x. Compared to its recent history, that's fair, but it's certainly not cheap.
You're paying up for the quality and predictability.
You are. You're paying a full price for a predictable, durable, modestly growing stream of cash. The investment idea here isn't really about hoping the price jumps because it's undervalued today.
It's about the long term.
It's about its robust long-term compounding power, buying and holding a high-quality compounder.
Okay, makes sense. What are the biggest risks then to that long-term view, beyond just market noise?
I think the most significant and maybe the most insidious risk is what the analysis calls systemic ESG failure and brand erosion.
ESG, environmental, social, governance.
Right. The cumulative weight of all those controversies we touched on, child labor in cocoa, water rights, plastic pollution, could finally break that reputational firewall between the corporation and the brands.
And if that happens?
A fundamental shift in consumer consciousness, particularly among younger, more socially aware people, could lead to a permanent rejection of key brands.
Directly damaging those intangible assets.
Irreparably damaging them. That's the big lurking threat.
And the second major risk identified.
Climate change impact on key commodity supply chains. This is fundamental. Nestle depends on global agriculture.
Coffee, cocoa.
Exactly. The company itself points to climate risks, droughts, extreme heat as material threats, threats to the availability, the quality, and the cost of critical raw materials.
Especially coffee and cocoa, the foundation of their biggest segments.
Yes. A permanent disruption there. A structural shift in supply that would irrevocably damage earnings power. No question.
So given all this, what does the general market think? The consensus view? And how does our deep dive analysis differ?
The market consensus right now is, well, pretty lukewarm. Generally a hold rating.
Why is that?
Wall Street analysts seem mostly focused on near-term headwinds. Things like softening consumer demand post-inflation.
And the impact of those price hikes.
Critically, yes. The negative impact of price increases on the volume of products sold what they call real internal growth, or RIG. They see the stock as fairly valued given these sort of modest short-term growth prospects.
Okay, that's the market view. But our analysis takes more of a second-level view, right? looking deeper.
Precisely. We believe the market might be overly focused on these cyclical headwinds the next few quarters.
And potentially underestimating something.
Potentially underestimating the profound structural durability of this business, its relentless long-term compounding potential. That recent slowdown in volume growth, for instance.
The market sees it as a problem.
Right. But our analysis suggests seeing it as a temporary, even rational consequence. Management smartly used its pricing power during a massive inflationary storm. That's arguably a sign of underlying strength, not weakness.
So the core difference is?
We believe the market might be undervaluing the true resilience and the sheer longevity of Nestle's economic moat, taking the longer view.
Right. So we've covered a lot today. We've taken a deep dive into Nestle's, well, rock-solid business model, its powerful economic moat.
That fascinating tension, too, between the brand love and the corporate controversies.
Yeah, plus its disciplined leadership under Schneider and that impressive financial resilience we just discussed.
And we've also explored those significant long-term risks, from reputation to climate change, and contrasted the market's shorter-term focus with a more patient, long-term investor perspective.
It really is a compelling study in enduring business quality.
It truly is.
And as you, our listener, reflect on this deep dive, here's maybe a final thought to mull over. For decades, Nestle has quite successfully kept its beloved product brands largely separate from its corporate controversies. But in today's increasingly interconnected, socially conscious world, what would it truly take for that carefully built firewall to finally crumble and fundamentally change the nature of its economic moat? What stands out to you from this deep dive?